Let's take a look at the two most influential people in the world of wealth creation. One is known for his long-term investments, and the other is a renowned trader. If you're an avid stock market enthusiast, you might have already guessed the names: Warren Buffett and George Soros. Both of these gentlemen have made huge piles of money over their lifetime in the stock market, but in totally different ways. So which way will put investors on top? Trading and investing are the two broad classifications of stock market activities. Trading focuses on short-term buying and selling, while investing involves buying and holding securities for an extended period of time. In this video today, we'll talk about both of these approaches and help you decide which one suits you better. Now, without further ado, let's start with the basic concept of stock trading and investing. Trading is an active short-term strategy to earn wealth. It's all about buying and selling of shares or commodities or even currencies with the aim of making short to medium-term gains rather than long-term growth. The basic technique involved in trading is buying at a lower market price and selling it at a higher price within a small period of time. Traders need to be attentive to make profits within the time frame they want to live in order to avoid losses. Investing, on the other hand, is traditionally related to buying stocks or other financial instruments that are expected to fetch returns over a long period of time. They're often held onto like family silver for several years. Investors always select stocks or bonds of companies which are expected to grow in the long term. This is why investing involves intense fundamental research about the potential investment target, be it a stock or a long-term bond. Investors don't sell their holdings regularly. It's only in a case of emergency or when the stock has met its long-term targets. So what's the difference between trading and investing? Well, the main difference between trading and investing is that the former provides opportunity to realize profits from volatile trends in the market. In investing, short-term gains and losses are ignored for the long-term gains, which are achieved as the company grows. On the other hand, traders will concentrate on the perceived market value of the stock. They would not be interested in the financial health of the underlying company. An investor, though, would be thoroughly interested in the company's financial performance more than the share's trends. Also, trading requires holding onto a stock or financial instrument for a day or maybe until it hits a short-term target, while investing involves holding onto a stock for longer durations. So what's the right approach for you? There's no hard and fast rule that one is good and the other is bad. The differences between investing and trading have their own requirements, like doing fundamental analysis, reading the charts, and keeping track of the graphs. For your help, here are a few questions that you can ask yourself before you make your own decision. Number 1. What are your investment goals? Are you looking for long-term growth or a quick win? Investors generally aim for steady returns and growth over time. They're not overly focused on small price changes because their objective is an overall return over time. For example, an investor might be looking for an investment that delivers a 4% dividend and 4% growth year on year. As long as this goal is being met, they might hold on to the investment indefinitely. While traders are generally less concerned with the long-term returns or a company's long-term prospects. Instead, they aim for lots of small profits frequently. So if you're looking for small profits and don't care about the long-term prospects of the company, trading is for you. But if you're someone who's looking for a long-term growth and someone who does not want to spend time making small profits against a price action, investing is for you. Question number 2. How much time do you have to manage your investments? Do you typically buy a stock, sit back, and hold it through the market's ups and downs? Or are you more likely to spend hours every week watching your portfolio and waiting for any price movement? Investors generally don't spend all their day monitoring their portfolio. They might do research on the weekend or after work and then just check on their investments from time to time. Traders, however, dedicate more time and attention to monitoring their investments. Their goal is to take advantage of small price movements, so they might need to sell quickly and on short notice. Traders also need to spend time keeping records and closely watching their brokerage costs. So if you can spend hours reading charts and graphs daily, then trading would be the thing for you. If not, you'd be better off with long-term investments. Question number 3. How much risk are you comfortable with? Whether you trade or invest, your capital is at the mercy of markets. When it comes to investing versus trading on the basis of risk, trading ranks a little bit higher. This is because trading involves taking super quick, short-sighted decisions which may go well or even go horribly wrong. Traders do not base their decisions on how promising the growth prospects of a business are. They may buy a script based on external influence and lose money when the prices hit a low. On the other hand, investing as a habit takes time to develop and reaps results in long term. So the risk here is pretty low. You hold stocks for a long time, and by then, your investment can fetch higher returns due to compounding effect of interest and dividends. Also, if the stock you have invested in is fundamentally strong, the daily market fluctuations will have negligible to no impact on your investment. So if you're a risk taker and feel okay with money being at a high stake, you can go for stock trading. If not, investing could be a safer option for you. Question number 4. Are you someone who wants to earn fast cash? Since the risk of trading is significantly higher than that of investing, the profits from trading is also significantly higher than the profits people could make from investing. The simple finance principle of the higher the risk, the higher the possible return, and vice versa applies here as well. A trader is often making decisions quickly, while an investor can adopt a slower approach to making decisions. If done well enough, a trader could almost double their money within a few months or even days. Investors would be able to do so only within a few years. So if you're looking to make huge money in a short period of time, stock trading is for you. Long-term investing and trading are two different methods for approaching your ultimate financial goal. Whichever strategy you use depends on whether you like to get into the day-to-day ups and downs of the market or prefer to ride those long-term fluctuations. Neither is right or wrong. As long as you have a goal in mind, a plan in place, and the patience to get there, you can use trading, investing, or a mix of both to make the most of your portfolio strategy. That's it from us in today's video. Thank you so much for watching. Let us know in the comments what you prefer, stock trading or investing. Please leave a thumbs up and share the video if you found it to be useful. For more videos on investments and personal finance, click on our channel and don't forget to subscribe. Catch you guys in the next one.